All right, welcome to this explainer. Today we're going to demystify the inner workings of high-level wealth management. We're going to prove that securing a massive loan isn't actually just about how much money you have. It's entirely about how your assets are structured. We're diving into Lombard loans, which is basically securities-based lending, and we'll break down exactly why your standard private banks often drop the ball, while specialist lenders actually get the deal done.
Okay, so here's our quick roadmap. We'll look at the limits of standard lending, run through 3 real-world trials: the time-sensitive co-investment, the competitive property bridge, and navigating the tax trap, before wrapping up with what lenders actually assess and ultimately the real power of structure. Let's jump right in.
Section 1. Limits of standard lending, the structural reality. Let's start by establishing the core conflict that high net worth borrowers face when they bump up against rigid private banking systems. I really want you to ask yourself this. Why would a wealthy client, someone who's been with a bank for literally years, holding an incredibly well-managed, massive portfolio, still get blocked by underwriting rules? I mean, it seems completely counterintuitive, doesn't it? They have the assets, they have the relationship, but when they need immediate execution, the bank just says no. Well, it turns out the issue is rarely the quality of the assets themselves.
And this is exactly where that friction lies. Retail banks, they rely on standardized advance rates and a super rigid collateral list. Now, that works perfectly fine for a simple portfolio, but the second you introduce complexity, things like concentrated positions, cross-border custody, managed fund exposure, or maybe an incredibly tight timeline, those standard frameworks just completely break down. Specialist lenders, on the other hand, they focus on agile, negotiated structuring. They aren't just checking boxes on a generic list, they're actually looking under the hood at the underlying mechanics of the portfolio itself.
Moving into Section 2, the time-sensitive co-investment. The first trial. Let's dig into a real-world scenario involving an entrepreneur with a £15 million portfolio sitting at a private bank. And suddenly, they need £5 million, incredibly fast. The ticking clock here? An extremely tight 18-day window. This entrepreneur has a golden opportunity to participate in a highly lucrative private equity co-investment. But that capital absolutely has to be deployed in just 18 days. And this, right here, is exactly where the standard bank framework starts to crack.
So, under the bank's rigid criteria, they were only willing to lend against listed equities at a 25 to 30% loan-to-value, or LTV, which meant our entrepreneur was left with a massive shortfall of over £1.5 million. Now, to bridge that gap, they would have had to sell off assets they'd been holding for 4 years. Doing that would have triggered a severe capital gains tax liability. It would have completely disrupted a beautifully managed portfolio just for a short-term funding need. Honestly, it just didn't make any sense.
So instead of just accepting the bank's limits, a specialist lender steps in. They ran a full portfolio analysis and actually found eligible collateral in the form of managed funds. Funds the bank had simply ignored because, well, they weren't on their standard little list. By bringing those into the mix, they underwrote the loan at a 40% blended LTV with fixed pricing, which totally removed the risk. The result? The full £5 million was drawn in exactly 17 days, the PE position was funded, literally 0 assets were sold, and 14 months later, the facility was seamlessly repaid right from the investment's distributions. A real game changer.
Let's jump to Section 3, the competitive property bridge, the second trial. This scenario shifts gears to a completely different type of pressure. It's a race against competing buyers for an international executive. The stakes this time are a £3.5 million cash acquisition of a prime London property. Now, the executive has a healthy £10 million investment portfolio to back them up, but the vendor of this property is highly demanding and absolutely refuses to sit around waiting for standard bank processing.
Conventional mortgage routes were instantly off the table. Because of cross-border income and some pretty complex currency situations, standard underwriting was going to take 8 to 12 weeks. That timeline was totally a deal-breaker for a vendor demanding a fast cash transaction. A short-term Lombard bridge was quite literally the only viable structure to save this deal.
Now, the deliberate strategy here is fascinating. It wasn't about pledging every single eligible asset to get the absolute biggest loan possible. Instead, they optimized entirely for speed. By arranging a facility at roughly 35% LTV against only the most liquid assets, the funds were released in under 3 weeks. This let the executive snatch up the property right out from under the competitors. And then, within 6 months, a standard mortgage was put in place to repay the Lombard bridge, absorbing the cost incredibly smoothly right into the acquisition budget.
On to Section 4,
Navigating the tax trap, the third trial. Our third high-stakes story is basically a regulatory minefield, where a client needed £1 million to fund a family gifting program. Think about this wealth distribution for a second. Out of £12 million in total assets, a whopping $8 million is locked up in a pension structure. Because of strict regulatory constraints, borrowing against that massive pension chunk was completely impossible, totally off the table. So that left only the £4 million personal investment portfolio to somehow solve the problem.
Now you see, the problem wasn't a lack of money, it was the sequencing. Liquidating that personal portfolio to get the $1 million would have crystallized a brutal capital gains liability at the absolute worst point in the tax year. Instead, they took a much more strategic route. They arranged a 25% LTV Lombard facility against the personal portfolio on an interest-only basis. This funded the gift without even touching the pension or triggering any of those unintended taxes. It's a perfect example of how the constraint is rarely the capital itself, it's almost always the interaction between liquidity and tax timing.
Moving on to Section 5, what lenders actually assess behind the curtain. Let's shift our perspective entirely here. What are specialist lenders actually looking at when they evaluate these huge, complex portfolios?
Okay, this is the absolutely critical insider takeaway. Your loan-to-value ratio is not some fixed output handed down from on high. It is a negotiation, and it is heavily grounded in preparation and collateral analysis. Borrowers who actually understand this consistently achieve significantly better outcomes than those who just accept the very first standardized offer a bank throws at them.
Basically, lenders are stress testing 4 key factors. First is liquidity. The Bank for International Settlements, or the BIS framework, drives haircuts based on volatility, not just the nominal value. Second is concentration. Heavy reliance on one single company reduces your achievable LTV because, frankly, trying to enforce against it could crash the market price. Third is custody. Clean pledge agreements with a single, well-rated custodian give a lender day one legal enforceability. And finally, the exit strategy. Every Lombard lender is underwriting their exit from day one. If you don't have a credible exit route, the loan is either getting declined or priced way, way too high.
Finally, Section 6, the power of structure. Conclusion. As we've seen today, through a rushed PE investment, a super competitive property grab, and a very delicate tax dance, the actual dollar value of your assets is really only half the story.
Ultimately, whether a facility is deliverable and exactly at what terms is decided before you ever even speak to a lender. It's all in the preparation. If you ever find yourself needing urgent liquidity, please remember that standard private bank solutions have serious limits. Execution is, at the end of the day, a structuring decision. So I leave you with this to ponder. When your moment comes and your portfolio absolutely needs to perform under pressure, is your current lending structure built to empower you, or is it just going to hold you back?